Forex brokers quote two prices for every currency pair. The bid price is the price at which you can sell the base currency. The ask price is the price at which you can buy the base currency. Every trade begins with these two prices. The difference between the bid price and the ask price is called the spread. It is also known as the bid-ask spread. The spread represents the cost of entering a trade. Many Forex brokers advertise zero commission trading. This does not mean trading is free. Instead of charging a separate commission, the broker builds the cost into the spread. The spread is the broker's compensation for providing liquidity and execution. When you buy, the broker sells to you at the ask price. When you sell, the broker buys from you at the bid price. The difference between these two prices is the transaction cost. This cost exists on every trade. Spreads are measured in pips. For most currency pairs, 1 pip equals 0.0001. For example, a quote of 1.1051 and 1.1053 represents a spread of 2 pips. Currency pairs involving the Japanese yen are quoted to 2 decimal places. For example, a US dollar to Japanese yen quote of 110.00 and 110.04 represents a spread of 4 pips. The concept remains the same. There are 2 types of spreads in Forex trading: fixed spreads and variable spreads, also called floating spreads. The type of spread depends on how the broker operates. Fixed spreads remain constant regardless of market conditions. They are typically offered by brokers operating a dealing desk or market maker model. These brokers control the prices shown to traders. Fixed spreads provide predictable transaction costs. They are often suitable for traders with smaller accounts. Since spreads do not change, cost calculations are straightforward. Fixed spreads can result in requotes during volatile market conditions. When prices move rapidly, the broker may reject the trade and offer a new price. Slippage can also occur when execution cannot keep pace with price movement. Variable spreads change continuously based on market conditions. They are offered by non-dealing desk brokers. Pricing comes from multiple liquidity providers and reflects real-time supply and demand. Variable spreads typically widen during high volatility. This often occurs during major economic news releases or periods of low liquidity. Variable spreads reduce the likelihood of requotes. They provide more transparent pricing due to competition between liquidity providers. They are often preferred by traders who need fast execution. Variable spreads are not ideal for scalping or news trading. Sudden spread expansion can significantly increase transaction costs. This can turn profitable trades into losing ones. There is no universally better spread type. Fixed spreads may suit traders with smaller accounts and lower trading frequency. Variable spreads may suit traders with larger accounts and frequent execution during peak hours. To calculate spread cost, you need 2 values: the pip value and the number of lots traded. Transaction cost equals pip value multiplied by the spread. If euro to US dollar has a spread of 1.4 pips and you trade 1 mini lot, the pip value is $1. Your transaction cost is $1.40. Spread cost increases linearly with position size. If you trade 5 mini lots, the cost becomes $7. Larger positions result in higher transaction costs. Every trade begins with a cost. Understanding spreads allows you to evaluate brokers, manage execution, and control profitability. Ignoring transaction costs leads to poor decision-making.